The Orange County housing market has officially hit a turning point, and we're only halfway through 2025. With inventory doubling since January and demand stuck in neutral, the direction of mortgage rates could define the rest of the year. Think of it like standing at a fork in the road. One path leads to cooler, slower market. The other, a surprising rebound. In this mid-year report, we are unpacking everything that shaped the market so far and what we expect as we move into the second half of the year. Whether you're buying, selling, or just staying informed, this is the data that matters the most right now. Hi, it's Christopher and Brooks Maher with MG Real Estate Advisors, your local Orange County realtors, with your mid-year Orange County housing market update for 2025. Now, let's break it down. Market at a crossroads. The housing market is stuck between two outcomes, and everything hinges on mortgage rates. In the first half of the year, rates remain sticky, hovering between 6.6 and 6.99%, with only a few brief days above 7%. As a result, buyer demand flatlined, affordability remained a challenge, and sellers continued to bunker down. Unless rates fall below 6.5% and stay there with duration, don't expect a dramatic shift in the second half. That's the inflection point the market is waiting for. Demand, flat for 2 years straight. Demand is sitting at 1,565 pending sales, down 4% from this time last year, and nearly identical to 2023 levels. Buyers are still active, but they are pickier, moving slower, and highly sensitive to interest rates. Demand actually dipped 3% just over the past 2 weeks as buyers took a break for 4th of July. Unless rates break below 6.5%, we expect demand to remain flat through the fall with only minor seasonal bumps. Inventory has doubled. The big story of 2025 so far, inventory. Active listings have surged from 2,401 at the start of the year to 4,817 today, a 101% increase. That's 58% more homes than this time last year and 112% more than mid-2023. This isn't just seasonal growth. This is the result of more sellers returning to the market and demand failing to keep pace. Still, we are not at pre-COVID levels. The 3-year pre-pandemic average for July was 6,708 listings. So while inventory is climbing, we are still 28% below those historical norms. Expected market time, slower but stable. The expected market time has grown steadily from 61 days in February to 92 days now, the slowest early July pace since 2019. Breakdown by property type, condos and townhomes, 85 days, up from 81. Detached homes, 97 days, down slightly from 98 days. For context, last year, at this time, the estimated market time was just 56 days. This increase signals more negotiation power for buyers, but also longer timelines and pricing pressures for sellers. Pricing trends, drifting, not dropping. According to Zillow's Home Value Index, home values are up 4.6% year over year, down 0.4% month over month. This confirms what we are seeing on the ground. Prices are not crashing, they're just slowly adjusting. Most homeowners have strong equity, low rate mortgages, and no real financial urgency to sell. That means even in a slower market, major price corrections are unlikely. Instead, we expect values to drift slightly through the second half of the year. Now, Christopher, where do you think things are going to go from here?
Thanks, Brooks. The future of the market hinges almost entirely on interest rates. Now, there are two potential paths emerging. The two paths ahead. Scenario 1. Rates stay elevated. If mortgage rates hold between 6.5% and 7%, demand stays flat or drops slightly. Inventory keeps climbing until it peaks in late summer or fall. Estimated market times rise above 100 days. Home values continue to slow month over month. Scenario 2. Rates fall and stay below 6.5%. If we see clear signs of a slowing economy, the Fed is more likely to cut rates. Rates drop and stay below 6.5%. Buyer demand spikes like it did in fall of 2024, up 14% in just weeks. Inventory peaks earlier than expected. Estimated market time shorten. Price stabilizes or even rebounds slightly heading into 2026. The luxury market. Slowing sharply, homes over 2.5 million are seeing longer days on market and fewer buyers. Luxury inventory is at 1,235 homes, virtually unchanged. Luxury demand down 7% to 160 pending sales. Luxury estimated market times up to 232 days, the slowest this year. Now let's break it down. 2.5 million to 4 million, 167 days. 4 million to 6 million, 318 days. 6 million plus, 410 days. That's August 2026 before they're in escrow. High-end sellers need to be highly strategic on pricing and marketing. Key takeaways. Buyers, you have more options and less competition than we have seen in years. Now, if rates drop, competition will return. So now may be your chance to get in before the shift. Be selective, but be ready to act when the right opportunity comes along. Now for sellers, price strategically from the start. With 92 days on average market time and 37% of listings cutting their price at least once, testing the market could be a costly gamble. Homes that are priced right and show well are still moving. Everyone. Now, we're not in a crisis, we're in a transition. Rates, not headlines, will dictate where we go from here. If you want honest insight and a plan tailored to your goals, reach out. We're here to guide you through the second half of 2025 with facts, not fears. If you found this helpful, like this video and subscribe for more. And if you're thinking of buying or selling in Orange County, reach out. Once again, we're here to guide you with facts, not fears. Thanks for watching, and we'll see you on the next video.